Hello again and welcome back. Thanks for watching. This week, I'm going to go through statistics from across the country, including the East Coast. I have important updates to my home buying recipe, so stick around for that. But first, I want to get into how house prices are at the lowest levels since the 1980s in real terms. So let me explain here. I have a few charts I've compiled for this one. First, the average home price versus the average household income in Canada. And you can see here the average home prices in blue, and you can see how it shot up over 600, almost 700,000 at this point in Canada. And look at those wages, barely risen much at all since the 1970s or maybe even 1980s. But they have very slow growth there. And these are in nominal values. This is not adjusted for inflation or anything. This is nominal values. And you can see, yeah, house prices have just run away from wages or from household incomes, which is pretty scary. And this is why no one can afford a house these days. And the next chart here really quantifies that separation in the house prices compared to the average household income. And you can look back to the 1950s here. It was about 2.6 times the average household income is what you would pay for a house. And then 1960s, very similar. 1970s, very similar. So it was very consistent there for 3 decades. And then in the 1980s, it went up to 3.1 times the average household income for the average house. And then 3.3, it just kept climbing. Look at 2000s. 4.5 times the average household income. We would consider that fantastic these days, by the way. Then 6.6 in the 2010s, and now in the 2020s. This is an average of all these decades, by the way. This is not just 1 year or an extreme case. This is an average wage and an average house price for the entire decade. And so far in the 2020s, we're at 9 times the average household income. So how did we go from 2.5 times to 9 times the average household income to buy a house? Well, something happened right there in the 70s, between the 70s and the 80s, a decade. And it was, of course, the gold standard. The US went off the gold standard, which we were included in because we were part of the Bretton Woods Agreement. And it was all based on the US dollar backed by gold. But of course, they got away from that standard and just had the license to print unlimited amounts of money at that point. And our dollar just became more and more worthless as the years went on until we're at the point now where it's 9 times the average household income to buy the average house in Canada. And it's not that houses got more expensive, it's that we got paid less and the dollar's worth less. And let me explain here on the next chart. This is the most important one here. So this is, again, I'm using gold. People use Bitcoin, whatever you want, but Bitcoin's too volatile. It really hasn't been established as a stable currency or stable form of money at this point. But of course, gold is. We used to use it as a standard, and it still trades every day at decent prices. So here is the number of ounces of gold needed to buy an average house in Canada. And these have been converted from the US currency exchange rate to the Canadian for the decades in question here. So you can see prior to the 1970s, it actually cost more gold to buy a house. It was 371 ounces in the 50s, and in the 60s, it was actually 528 ounces. And in the 70s, it was 344. And you can see after we came off the gold standard, gold went up in price actually in dollar terms, but of course, it only took 144 ounces to buy the average house. And it's been coming down. It went up in the 1990s, and it's been coming down ever since because our dollar is getting worse. But in real money, this is real money here. It is now about 200, just over 212 ounces or so to buy the average house in Canada. This is the least expensive that it has been since the 1980s when it was 144 ounces. So, of course, if you were paid in gold, you would be able to afford the average house right now. But, of course, gold would be too expensive to pay you in because money is cheap and worthless. So they're going to pay you in paper dollars and monopoly money. So, of course, this is why you really can't afford a home. But, yeah, looking at real money like gold, you could afford a home. They've actually got cheaper since the 1980s. And this video is sponsored by you, the viewers. Thanks for watching, liking, or disliking, and of course, subscribing to this weekly content. Now I'm going to get into the housing stats, but I'm going to pick on Calgary before we get into that. This is from the Calgary's latest media release here for their statistics for August. And the benchmark price, I'm not going to worry about. I hate benchmark prices, so I'm not going to look at that. Now let's look at the sales there on the top. So they are down 19.5% from last August. So that's a big decrease. New listings are up 13%. So huge change there. Look at the inventory there on the right, up 37% over last August of 2023. And the months of supply is up 70.6% over last August. Still very low. 2 months of supply is very low, but look at the change compared to last year. And of course, days on market's up. So everything is increasing when it comes to inventory, days on market, months of supply, all that kind of thing. So of course, the Calgary market is still hot for now, but it has seen some significant changes since last year, and we'll continue to monitor it. And I'm guessing it's going to trend like the rest of the country, especially Ontario, but it's just got that lagging time because the speculators went there after Ontario looking for the next best thing. Now let's look at the stats for the rest of the country. Here are the month-over-month price changes from July to August this year. This is based on the average MLS price. So the biggest drop or the biggest change is Barrie and District down 9.2%. Then you have Northumberland Hills down 6.8%. Now you can see on this chart, there's a lot of places, and the majority of places are down month over month. Of course, the summer is slower times for most places, but some significant places here. Toronto down 5% month over month. Nova Scotia down 4.4% month over month. Saskatchewan down 3.2% month over month. Ottawa down just almost 3% month over month. Greater Vancouver down 2.5% month over month. Durham region down 2.4%. All the GTA places are down around just over 2% or so. Edmonton down just 1.1%. Not much change there. Montreal up 0.5% month over month with their prices. Calgary also up 0.5%. Not much change there. Hamilton, Burlington up 2.2% month over month. Fraser Valley saw a 3.2% increase, and Newfoundland and Labrador 5% increase from last month. And they've actually reached an all-time high, which we'll get into right now. Now looking at the percent change from the peak for all of these areas, and leading the show there is Brantford at 27.6% decrease from the peak from their all-time high back in 2022. Northumberland Hills down 27% also. Peterborough 20% down, Durham region 26.6%, Cambridge down 25%, Guelph down almost 25%, Peel region down 24%. These are big losses. I say this every time, I think, but yeah, 25% loss from a peak is pretty significant, and we haven't even entered a recession yet. London area, 24%, Southern Georgian Bay, 24%, Barrie and District, 23%, Chilliwack and District, 21%, Halton region down 21%, Kingston and area, 21% down, Niagara region, where I'm from, down almost 21%, Lakelands, Muskoka down 20%, Grey Bruce Owned Sound down 20%, Hamilton, Burlington down 18.8%, Windsor, Essex down 18.5%, Fraser Valley down 18%, York region down almost 18%, Toronto down 16%, Huron, Perth 16%, same as Toronto, Simcoe District down almost 15%, Victoria, BC down 13.6% from their peak, Ottawa with all those government jobs even down 13%. Interior BC, Okanagan down 10%, Greater Vancouver only 7.2%, Nova Scotia down 7% also. Saskatchewan down just under 5%. Calgary down 2% from their peak, which was this year. Province of Quebec down 2%, which also had a peak this year. Edmonton down 1.4%. Same thing this year. They had their peak. Montreal down 0.2, pretty even with their all-time high. And Newfoundland and Labrador, they are up 5.2% from their all-time high, which was this year also. Translating that into dollar values, wow, over 300,000. We have Durham region, Peel, and Halton region. Huge losses. That's like you could buy a whole house in some provinces for that. York region down 275,000. Look at all the places down 250 to 275. Southern Georgian Bay, Guelph, Cambridge, Brantford, Northumberland Hills, Peterborough. Then we get into the under 250 range, 200 to 250. We have Barrie and District, Fraser Valley, Lakelands, Toronto, London area, Hamilton, Burlington. Then the sub 200, Chilliwack and District, Niagara region, Grey Bruce, Kingston, Victoria, Windsor, Essex down 133,000. Huron, Perth down 121,000. Just around that $100,000 mark here, we have Simcoe District, Ottawa, Greater Vancouver, Interior BC, Okanagan Valley. Then at 76,000, we have Interior BC, Okanagan Valley, Nova Scotia down 33,000, Saskatchewan down 16,000, Calgary down 14,000, Province of Quebec down 10 grand, Edmonton down 6,000, Montreal down just $1,000, and lastly, Newfoundland and Labrador up $17,000 from their all-time high, which was just a couple months ago. Maybe it was last month, but it was this year. And why is Newfoundland and Labrador making all-time highs, you may ask? It's because it is literally the last place in Canada where you can go buy a house for these prices. And of course, the speculators really have nowhere else to go. So they are going to Newfoundland now, onto the Rock, to see if they can pump prices there. Problem is, they're going to pump them up, but when they go to sell them, they're not going to be able to sell them for like years and years. But anyway, that's a risky investment in Newfoundland. So good luck to you out there. Now let's look at the market balance. The sales to new listings ratio for August, and in a buyer's market is Southern Georgian Bay, Peel Region, York Region, Lakelands, Muskoka, Fraser Valley, Toronto, Simcoe, and District, all buyer's markets. Majority of the places are on the balanced market there. You can read through them. And then when you get to the seller's market, you still have the usual suspects, like I go over almost every month now. Montreal, Calgary, Province of Quebec, Saskatchewan, Huron, Perth, for some reasons in there this month, Newfoundland and Labrador, Nova Scotia, and Edmonton. So that's it for the stats. Now let's get into this home buyer recipe. So we had some significant updates last week. Of course, rates continue to fall. The Bank of Canada cut another 25 basis points, and the unemployment went up over 6.5%. It was 6.4. It's now 6.6%. So that warrants an update to the home buyer's recipe. We're getting close. I don't know how much longer it's going to take, but we're heading in the right direction. For any home buyers out there looking to take advantage of this market, this is getting close to your time. Now, this home buying recipe is a general guideline for people to use that I have tracked historical stats to say when these things happen, usually prices are at a point where you would want to consider getting into the market if you're skeptical of where things are going. But of course, they do track historical trends when it comes to mortgage arrears and all the rest of these things that are on here. So let's go through them here one by one, starting with the falling prices here. So of course, prices have been falling since 2022. We're making lower highs. Actually, if you look at this year now, 2022 is the big peak. Then 2023 is the next one. After that, it was lower. This one has been lower again. So we're making lower highs. And of course, we're going to see lower lows at some point in the future, especially when the rest of these things are filled in. Next, we get onto falling rates. Historically, falling rates, prices fall along with them for a certain amount of time, a year to two. So this is a good sign. This means the market's in trouble. They're trying to stimulate it. The high rates have done their job, but of course the damage isn't done yet. Next is high unemployment. This is the big one. This has gone up again, and it went up beating expectations of what the experts, whoever they are, thought. But of course, we're up to 6.6%. The next battery bar will be at 7% unemployment, and the next one probably at some point after that. I don't know how high unemployment's going to go, but of course, that will fill in very shortly, I'm guessing. But it'll be interesting to watch that statistic going forward. And lastly is the high mortgage arrears and delinquencies. This is a lagging indicator. This latest statistic or the latest data on this chart is only from June this year. So this is, 2-3 months behind the actual market. And this only includes the 11 big banks. When I look at the MLS listings, of course, if I track those, that has increased significantly since last year. But these ones, I want to track the big banks because when they start having higher delinquencies and arrears, that's when things will really start to get interesting. So anyway, some good progress on this home buying recipe since last time, and I'll continue to fill this in as needed in the future going forward. That's it for this week. Thanks for watching, and I'll see you next time.